In our final video on the presentation of the income statement, we're going to be looking at the presentation of a very important number, earnings per share, which has been stated and shown to be the most reported number uh, that is given out in the financial statements. Earnings per share is based on the number of common shares that are outstanding throughout the year using what is known as a weighted average approach. And this is something we're going to be discussing in Intermediate 3. If a company has no separately reported items, that is, there are no discontinued operations, no extraordinary items, no prior period adjustments brought about by an accounting error, then only one earnings per share amount is going to be reported, and that is earnings per share based off of net income. So we take the net income, we divide that by the number of shares that are outstanding, and that gives us our earnings per share for net income. When we do have separately reported items, as we have here from our kitchen sink company, we're going to report starting with our income before extraordinary items. So we're going to give this number, which many believe has a highly predictive value. That is, you can base your future-oriented decisions on this historical number. And we're going to divide that by our earnings per share to give us a per share from continuing operations before extraordinary items. So this is the income per share from the operations that are going to go on. It excludes all the discontinued operations and those unusual and infrequent events that occur. We're also going to present on a per share basis the amount of the gain or loss net of tax from the discontinued operations. Again, we'll take that, divide it by the number of shares, and present it here so the users can see the effect of discontinuing the operation. There was a loss of 2 cents per share. Well, that should be something to be encouraging for our users, because this operation that was operating at a loss will no longer be part of the ongoing operations. And then finally we have our extraordinary item, again presented net of tax, divided by the shares to give us a per share amount. And the users can see that this infrequent and unusual event had a negative impact on the overall net income, and since by their very nature they're unusual and infrequent, does not give good predictive value. So the inclusion of discontinued items and extraordinary losses labels this not to be a very good predictive value. So when we have situations like this, GAAP requires that we report from the income from continuing operations, which is the most predictive value on the income statement, where you have discontinued items, discontinued operations, and or extraordinary gains and losses.